Hey, what's going on, you guys? My name is Carson Rouse, and welcome back to Business Buzz, where we focus on business, entrepreneurship, and investing. Today, I'm going to be talking about the 3 best high-tech growth stocks that you should consider investing in. Now guys, before we get into this video, I want to mention that I am using my American flag backdrop today. It's absolutely beautiful because I am shooting it on 9/11. It's been about 19 years since that great tragedy swept the nation. But what it did do is bring our nation together. People once again cared about one another, and I think that needs to happen in our country again, but this time without a tragedy. So with the market being insane lately, with all of its ups and downs and flips and turns, you might be wondering, is there a way that I can profit from all of this madness? Tech stocks in specific have been plummeting lately. In fact, the Dow Jones is down around 400 points just in the last week. But this isn't our new normal. Heck, the last few months, the market has done exceedingly amazing. Ever since the pandemic and that big market downturn, the market has fully recovered and then some. It's been an absolutely crazy ride this year. With that said, though, I think a lot of investors saw the market was getting too high and the stocks they were invested in were just too richly valued, and they started selling off some of their shares. There's also some rumors going around about some potential stock market manipulation from big banks and investment firms. Either way, though, I just want to cover 3 good growth tech stocks that you should consider investing in. I think these have a lot of room to grow, and you have the potential to make a good amount of money. Now, I will say I'm more of a value stock person myself. It is way easier to analyze value stocks, but I think it's good for any investor to have a few growth stocks in their portfolio. They give your portfolio a lot of potential to make a lot more money. Number 1, Amazon. So I know none of you have ever heard of this company. You know, they're a startup. I'm sure none of you have ever used it. Of course you have. It's Amazon. We all use Amazon. We use it in our daily lives. We use it for a lot of our groceries, a lot of our common household items, our phone chargers, everything you can think of, we use Amazon for. In fact, Amazon is one of the few companies in the world that has a market cap exceeding $1 trillion. And they exceed that by a considerable margin. Now, there's only a few companies in the world that can say they are a $1 trillion company, and Jeff Bezos can say that he owns one. So we all know that Amazon has totally taken over the e-commerce world, but did you also know that they're involved in many other business ventures? They are pretty well diversified, actually. Don't forget about the cloud computing and the AWS services that Amazon is getting their feet wet in, and many other business segments. But just to show how much of a growth stock that Amazon is right now, their current PE ratio is around 124. Just for reference, a good PE ratio is between 2 to 4. You definitely don't want to buy anything over 10, but this is Amazon, and that is extremely high even for their industry. And again, that's because with growth stocks, you're not buying the stock for what it is now. You're looking 20 years into the future and saying, okay, I'll buy it. I think it's worth it. It's also worth noting that in the last year, Amazon stock has risen over 70% to around $3,175 a share. One of the biggest beginner mistakes that investors make is thinking that after a stock goes up too much, you shouldn't even look at it. Like if a stock goes up, if it almost doubles in value, don't even look at it. You'll never make money off that. But that is a huge mistake. There are a lot of people out there. I've made mistakes like this before. You own a stock that's $15, it goes up to $25, and you think you're rich and you sell it all off. But then a year from now, it's selling for $100 a share, and you missed out on a ton of money. But the fact is that Amazon has tons of room to grow still, like a lot, especially in the new things that they're getting involved in, like cloud computing. Cloud computing is expected to be a massive industry. It's taking huge strides every year, and Amazon has the resources to be a major player in that industry. Another segment of their business that I think is poised for much more growth is their e-commerce side. You might think that it's starting to top out. So many people use it. It can't get much bigger than it already is, but I would beg to differ. In fact, the FAA just approved Prime Air for Amazon, where they'll be able to deliver packages with drones in under 30 minutes. The day that I get a package delivered from a drone is the day that I'll realize I'm living in the future. With all of this excitement and growth, it's hard to see the stock slowing down anytime soon, and I think this is a great long-term play. You almost can't go wrong with buying Amazon stock. It's kind of like buying Apple stock. Like, you're not stupid if you buy it. Now, I know what a lot of you beginner investors out there might be thinking. Well, Carson, Amazon is a $3,000 stock. There is no way in heck I will ever be able to afford to buy even one share, at least right now. Actually, you can through fractional share investing. A lot of the new free brokerages nowadays offer fractional share investing. So if you only have $1,000 and want to invest in a $3,000 stock, instead of not being able to afford it, you can buy 1/3 of one stock and invest the same way that everybody else is. Number 2, Square. Square is another very large tech company that I'm sure you've heard of. However, you might not be quite as familiar with their business model as you are with, say, Amazon. So I just want to go over their business model real quick for you. So Square's main business segment has to be involved in giving businesses payment method capabilities both online and in store. If a business registers with Square, they can basically accept any credit or debit card on the market. For example, if it's in store, it'll be a little card reader, and for every purchase, Square usually takes 10 cents and 2.6% of the sale. So what's great about that business model is that even after you get a company to sign up, instead of just making money one time, you'll be making revenue consistently through as long as that company uses your product. If you think that's cool, make sure to go down and give this video a like for me. I also tried filming this video earlier and it totally wasn't recording and I had to redo the whole thing. So please, for that, give me a like. I want at least 25. Thank you so much. Square also has something called Square Capital, where they offer people cash advances, and of course they can make interest on that. They're kind of in the same realm as like PayPal and LendingTree. Those are kind of their biggest competitors. And that's kind of a good thing because a lot of people have huge problems with both PayPal and LendingTree. I mean, there is a laundry list, and Square is a fast-growing company, and I honestly wouldn't be surprised if we could see them exceed those companies by a considerable margin. Square currently has a market cap of around $62 billion, which is a very good-sized company, and they've also just become profitable recently in the last year, whereas in the 4 years previous, they were not. So they are headed in the right direction. In fact, they had a net income of $300 million, which won't blow your boots off, especially for a $62 billion company. But again, it's pretty decent and it's showing that they're growing. Now, there is a bit of a gamble with this company. A lot of cynics think that maybe the only reason that this company has done so well in the last year is due to the pandemic, and will that stay course after the pandemic is basically over with? And I think that it will, because yeah, of course, during the pandemic, a lot of companies moved online and wanted to add new payment capabilities for their businesses, but I think this will stay the course because I think that Square's customers are going to enjoy their products and become reliant on them so much that they will continue to use them. Online shopping has seen a huge spike in the last few months, but again, I have the same logic here. I think that people will become so used to and reliant to shopping online that I think this will basically stay the course. I think that it's odd, but the pandemic actually did good things for moving forward in the economy to different online payment capabilities and shopping. Did you know that Square also owns Cash App, and they just recently added Bitcoin trading to that app, which could bring many new people to the app. And every time somebody buys or sells Bitcoin on the app, they have to pay a fee, and of course that's going straight into the pockets of Square. But now I want you to let me know down in the comments whether you think that Square is a grower or a shower. Number 3, Chewy. So I'm sure none of you guys expected to see this stock on the list. In fact, I'm sure many of you haven't even heard of it. And it's not necessarily a tech stock per se. I'm kind of cheating here a little. It's not really a tech stock, but it is an online retailer, so I'm going to count it as one. More specifically, Chewy is an online pet supply retailer. So Chewy actually creates and sells products to customers that own pets, like dog food and toys and treats and all that. And honestly, people love their animals, so they're willing to shell out some money for some special treats for that special someone. Now, Chewy is actually owned primarily by PetSmart, but there is a small window open for investors like you and me. They currently have a market cap of around $24 billion, which isn't mind-blowing, but for an online pet supply retailer, it's pretty good. And they are not quite profitable yet, but I don't think that should deter you from checking out their company. Their revenues are steadily increasing, and they're looking into cutting some costs to finally reach profit. Their stock is up about 80% in the last year, and they currently sit around $58 a share, and many people think that that is way too low. Now, of course, COVID did definitely help with their recent revenues and their stock price and all of that, but they are honestly becoming a leader in the pet supply online industry. It might be kind of a specific industry, but they're leading it. Many studies have concluded that more and more pet owners are going to online to purchase products for their pets, and of course Chewy is coming in at the right time because they're becoming a leader in this industry as more and more people go to online for their doggies. This is really one of the few online pet supply companies that you can invest in right now, and online shopping is obviously the future and really the now, so it's not a bad idea. So I would say this is an early opportunity for you to get yourself involved in, and I would definitely check it out. Anyway, thank you guys so much for watching this video. I really hope you enjoyed it. Again, please give me a like for all this trouble I went through. I'm sorry if I sounded a little tired or if I rushed through it with my voice a little too much, but I honestly filmed basically the entire video, and then I realized it was a black screen and it wasn't even recording. So for that, please go down and give me a like. Anyway, subscribe right here, and I'll see you guys next time.